We'll just give it a second here. I can see the people starting to flood in, so we'll just give 1 minute for people to join. All right. Well, welcome everybody. I want to start by thanking everyone for taking time out of your day to join us today. I'm Jacob Milosek. I'm a tax partner here with Henry Warren, and I'm joined today by my colleague, Nick Raycroft. Nick is one of our senior tax managers and works closely with me in our tax group. We've put together a presentation today that we hope is going to be fairly topical for folks. Personal taxes are obviously top of mind, and so we're going to go through a lot of areas that we get a lot of questions in. This is the third webinar we're doing in kind of a monthly webinar series. And so if you missed our first two webinars and you wanted to look back at some of those, we'll give some direction on how you can do that by finding them on our website or YouTube channel. And if you're interested in joining us for future webinars, let us know, and we'll make sure you get information about how to join on future ones as well. In terms of what we're going to cover today, we're going to cover off a lot of areas that, as I mentioned, we get a lot of questions in. We're going to go through this relatively quickly, but hopefully at a level that you can get the main takeaways we want to share with you. At the end of the presentation, we've left open a few minutes for question and answers. If you do have questions throughout the presentation, we'd encourage you in the Q&A section of Zoom just to log your question, and we'll do our best to get through those at the end of the presentation. We're using something today called Menti. So for those that aren't familiar, Menti is a system that allows us to get your feedback and input on certain questions. And there's two ways for you to join us in this process today. You can either scan your phone on the QR code you see on screen, or you can go to menti.com and enter the 8-digit code you see. Now, if you run out of time and you don't get the 8-digit code down, that code will be available later in the presentation on the question slides. I would encourage you to try and join us on that because we do think it really adds to the presentation. So with that, we'll go into our first Menti question. And our first question says, how confident are you when you file your personal tax return? And I should preface this question. I know that there's a lot of Henry Warren clients on the presentation today. So even if you personally aren't confident, hopefully you're confident in us, maybe in helping you with your filing. So we'll just give a few seconds for some of the answers to roll in. Perfect. So we'll jump to our next question. This one's a little more technical. What interest rate is CRA currently charging on unpaid tax balances? So when we look at CRA interest, there's a couple things to keep in mind. This interest is non-deductible, so we don't like that from a tax perspective. And the other thing is that the interest is compounded daily. And so this can become a very expensive source of financing. The correct answer is actually 10%. So the current rate CRA is charging is 10%. That means that in order to cover this off, you would need to earn a 20% rate of return on your investments to justify incurring that interest expense. So not very effective financing. So if interest is a big concern, well, we know that understanding our payment and filing deadlines is going to be important. The big deadline that most people are probably aware of is April 30th. So April 30th is the due date of your tax filing, but it's also the due date for any taxes that are payable. There is an extension for self-employed individuals to June 15th. So they give you an extra 45 days to file your personal tax return without penalty. But the payment of any tax is still due June 15th. And so you might sit there and say, well, if I'm self-employed, how do I know what to pay on April 30th if I'm not going to file my return until June 15th? And the short answer is that for a lot of our clients, whether they're self-employed or not, we try and get the return done by April 30th if we can, because then you can file and pay any taxes on time. If you don't have that luxury and you're filing after the April 30th deadline, you can send in an estimate of what your taxes might be before April 30th to avoid interest. One thing I'd say is that penalties and interest generally won't apply if you don't have any tax owing. And so you might be sitting there thinking, well, If I know I'm in a refund position, maybe I'll just wait and I'll late file my return for one reason or another. The caution I would have is twofold. One is if you do that and you end up, there's some surprise slip that you weren't aware of, or something happens that triggers you to owe tax, now you're into a penalty situation. And the second is a lot of government benefits are tied directly to the filing of your personal tax return. And so by not filing your return on time, it's going to delay access to things like the Canada Child Benefit, the GST credit, and the carbon tax incentive that residents of Ontario are eligible to receive. So generally, you want to file and pay your tax by April 30th. The other thing to be aware of is installments. So whether it's income tax or HST, if you owed more than $3,000 in the previous tax year, CRA in year 2 is going to want you to pay as you go in terms of quarterly installments. So to avoid installment interest, it's really important to make sure you're following along with required installment schedules. The next topic that we're going to cover is capital losses. So capital losses are losses that would be realized generally on investment portfolios like your stock account or perhaps on real estate. And generally, these capital losses can only be used to offset capital gains. There is some flexibility because we can either use the loss to offset capital gains in the current year. We can carry losses backwards up to 3 years to offset capital gains realized in preceding years, or we can carry the losses forward indefinitely to offset capital gains in the future. Now, if we're trying to go backwards and we're trying to recover tax that was paid in the preceding 3 years, there's a form that's part of the current year return. So on your 2023 return, you'd fill out what's called a T1A schedule. And on that T1A schedule, you indicate to CRA which years you want to carry your current year loss back to. Normally, if I had capital gains in 2020, 2021, and 2022, I'd want to carry that loss as far back as I could, because next year, let's say I had a loss in 2024, well, now the 2020 gains are going to be off the table. Like I can only go back 3 years. And so generally you want to carry your losses back as far as you can. The other thing we look at when we're carrying back losses is what was the marginal tax rate of the person in each year. So for example, if your income was super low in 2020 and maybe it was super high in 2021, there's going to be a better bang for your buck in terms of carrying that loss back to 2021 because you're going to recover tax at a higher rate. So we're also looking at that when we make that determination. The next thing I want to talk about is the principal residence exemption. And so for a lot of folks, you'd look at this and you'd say, well, this is pretty simple. My principal residence is exempt. You know, I don't need Jacob to tell me much more about this. There's a few nuances here that I wanted to go through and just highlight a couple points for you. So first is that in order to qualify, the property has to be ordinarily inhabited during the year. What does that mean? Well, there's been all kinds of court cases on this. But generally, ordinarily inhabited means that you have to have lived in the property for some period of time during the year. Very low bar to get over. So that one's fairly easy to satisfy. Must also be capital property, meaning that it can't be inventory. So if you're in the business of flipping homes, for example, it's likely that that sale of your property would be treated as business income and wouldn't be eligible for the principal residence exemption. A similar rule was introduced for 2023 called the anti-flipping rules. And basically what these rules say is that if you buy your home and you sell it within 365 days, generally, not only are you not going to be able to claim the principal residence exemption, but what you thought might be a capital gain and only 1/2 taxable is now going to be fully taxed as ordinary income. So not a good result. There are exceptions to the anti-flipping rules that are beyond the scope of what we're talking about today, but just to make people aware that there is some new rules in that area. We can only designate one property per year. So obviously, if you only have one home, that determination becomes pretty straightforward. But if you've got a home and maybe, let's say you've got a cottage that you live in as well at times during the year, there'd be a choice of, well, which property am I going to designate for each year? That designation isn't required until you actually dispose of the property. And so normally at the time that you sell one or both homes, we would look at, well, what property has the biggest gain per year? And then we would ascribe the exemption on that basis of whatever property had the highest gain per year. Prior to 2016, the government kind of administratively said, well, you know what, if all of the years are exempt and you don't owe us any tax on the sale of a principal residence, don't bother filing any kind of special reporting with your return. You don't have to report anything, and away you go. Well, starting in 2016, I think what happened is the government became concerned with people flipping houses, and they wanted more information about how often people were buying and selling their principal residence. And as a result, starting in 2016 and every year forward, if you dispose of a property, you now have to fill out Form T2091 and basically disclose that you've sold your principal residence. Now, this filing requirement obviously happens in the year that you sell your principal residence and you're trying to make the designation. But it can also happen if there's been what's called a change of use of the property. So again, the concept of a change of use and some of the nuances there are beyond today's presentation. However, at a high level, it's important for you to understand that if you had a property that's being used for personal use, maybe you move out of it and you start renting that property, you've changed the use of the property from what was personal and it's now a rental. And because of that, CRA views that as a disposition. And technically, you might have to file this form. The other case we see it is on death. You're deemed to have disposed of all of your capital property at fair market value. And so there's a special form called a T1255, which is very similar to the T2091 that you have to fill out in the year of death. So there's big penalties that can apply if you don't fill these things out properly. And so the next question we have on our Menti dashboard is, what is the maximum penalty that Mr. and Mrs. homeowner could be charged if they don't file their T2091 form in a year that they sell their principal residence? So I'll give everybody a second or two to respond. And for those that missed it, the code, the website is menti.com and the code's up at the top of the screen to join. So the correct answer here is $16,000, pretty steep penalty. So how does that apply? Well, generally the penalty is going to be the lesser of $8,000 or $100 per month for each month that the T2091 is late. So $8,000, remember, is per taxpayer. So where a property is jointly owned between Mr. and Mrs. homeowner, well, technically they each have to file the form and they're each subject to that maximum penalty of $8,000. What's interesting is CRA does have a voluntary disclosures program. So usually if something's late and maybe subject to penalty, you can come forward and say, oops, my bad, please accept this thing late and please waive any penalties associated with that. Unfortunately, the T2091 isn't available under the voluntary disclosure program. The moral of the story here, guys, is what seems like a very simple thing. There is a lot more nuance to it. So make sure you're reporting the sale of your principal residence and make sure you're getting advice because it can be fairly big implications. The last thing I'm going to cover off is home office expenses. So in recent years, there's been two methods we could file under. We could claim either the simplified method or the detailed method. And the simplified method, much like it sounds, was simple, it was easy, it's practical, and in my opinion, it was pretty fair in terms of what the deduction that was offered to taxpayers. So of course, being simple, easy, practical, and fair, CRA did away with this option. And so now what we're left with is the detailed method. And the detailed method, is much like it sounds, is more detailed, and it requires a little more work in terms of being able to make the claim. It's also a little harder to meet the requirements to be able to claim these expenses. And so generally the employee must be required to work from home, or they have to have entered into a formal work arrangement with their employer that says they are working from home. They also have to get a special form filled out by their employer called the T2200 that basically is a declaration from the employer saying that, yes, the employee was required to work from home during the year. So assuming we satisfy those criteria, we then have to have some reasonable basis of how to allocate the expenses. So Nick, on the next slide, generally the reasonable basis would be based on square footage of the home. So if I have a dedicated office space and that office is 10 feet by 10 feet, that's 100 square feet. If my whole house is 1,000 square feet, well, maybe I'd claim 10% as being a reasonable amount that I can claim. If I'm working in my living room, like a common area of the house, well, then a further proration might be required for the number of hours that I'm spending working versus the number of hours I'm catching up on Netflix or sleeping. In terms of eligible costs that I can claim for the home office, a lot of the ones are relatively intuitive that are listed on the screen. So the big one being rent. So anyone who rents their home, rent can be a fairly high cost. The good news is you can write that off for employment. There's also things like heat, hydro, water, no major surprises. Repairs and maintenance have to be reasonable to your office space. So if you put a new hot tub in the backyard, trying to claim that as a reasonable office expense probably wouldn't fly. But maybe if you put a new window in your dedicated office space, well, that should be something that you could claim. What's interesting here are the expenses that you specifically cannot claim. And as a tax guy, I usually try and understand the logic behind a rule. It helps me remember what that rule is. For these exclusions, I don't understand the logic, but specifically, you're not allowed to claim home insurance or property taxes unless you've got commission income. And you cannot claim anything to do with your mortgage, specifically mortgage interest, whether you're commission income or not. So just be mindful of that. Unfortunately, for homeowners, you're kind of precluded on what you can claim. So with that, I'm going to pass things over to Nick, who's going to talk a bit about different deductions you might see on your tax return.
Thanks, Jacob. So to start off my part of the presentation, I'll ask another question, and that is, what is the tax savings a taxpayer would receive when claiming a deduction on their tax return for the year? And so with a deduction, I want to highlight there's a difference between a deduction and a tax credit. A tax credit is often an amount at the lowest income tax rate. So federally, that would be 15%, and tax credits are tuition tax credits, the basic personal amount that everyone gets. And those are at 15%. So the correct answer is that it depends. And it will be based on your marginal tax rate for the year. So the highest marginal tax rate is above $200,000 in income. In Ontario, that's 53%. So if you're in the highest tax bracket, a deduction would save you about 53% in taxes. I have on the screen here a few common deductions that we see, so I'll run through those with you. The first one being childcare costs. So these are expenses for children under 16 that would allow you to earn employment income or run a business. The deduction for childcare expenses is based on a few different amounts. It's the lower of your actual expenses for the year, a prescribed rate based on the age of your child, or 2/3 of your earned income. And it's important to note that childcare costs are claimed by the lower earning spouse. So if there's one spouse that has $100,000 in income, but another spouse that has, say, $10,000 in income, they are claimed on that spouse that has $10,000 in income. So I think it would be nice if the higher earning spouse claim them, but unfortunately that's not the case here. With moving expenses, again, similar to childcare costs, the costs need to be incurred to allow you to earn employment income or business income. For moving expenses to be deductible, it needs to be what's considered an eligible relocation, and that involves moving more than 40 kilometers. Your new home is more than 40 kilometers closer to your new work location than your old home would be. So moves within a city are unlikely to be eligible for those moving expenses. But if you're moving from, say, Ottawa to Toronto for a new position with a new employer, those expenses would likely be eligible. Similar to home office expenses, there is a simplified and a detailed method. The simplified method is more based on a prescribed rate for kilometers driven, as well as a set amount for meals per day, whereas the detailed method is based on your actual receipts and your costs, such as the transportation costs for bringing your belongings from one location to another, potentially closing costs if you need to sell your home at your old location. So there are a number of expenses that can be claimed in in this with moving expenses. And there's often a kind of balance between claiming the simplified versus detailed method. Support payments are separated into spousal versus child support. Spousal support payments are deductible by the payer and included in income by the recipient, whereas child support is not deductible for the individual making the payment, and it's not included in income for the individual receiving the amounts. The important point with support payments is that they must be made pursuant to a written agreement. And so it's important to, when spouses are separated, to have a documented as to what amount is being paid is considered spousal and what amount is considered child support, because there is a different tax treatment for each of those types of payments. Three more that I'll run through are accounting fees. So clients of Henry Warren, we charge for our services, and those accounting fees would be deductible to the extent there's investment income, rental income, self-employment income. Those are deductible on your tax return in the year that they're paid. So 2024 fees that are charged will be deductible on your 2024 tax return. Similarly, for investment fees, fees paid to your investment advisor, portfolio manager to manage your investments, those are deductible. However, if there are fees paid within a TFSA, RSP, RESP, those amounts are not tax deductible. And I think the most common one for a lot of people will be RSP contributions. Those are deductible up to your RSP contribution limit for the year, which can be found on your notice of assessment. And in your online account with CRA, the contribution period is from March to February each year. So any contributions you make in March 2024 would be included on your 2024 income tax return, and you can make contributions up until December 31st of the year in which you turn 71 years of age. However, on my next topic, I'll explain why maybe you want to convert your RSP to a RIF, and that's because of pension splitting. So pension splitting allows kind of an equalization of income between spouses. Each spouse is required to file their own income tax return, but where spouses that are living together have eligible pension income, they can split that pension income up to 50% and transfer it from one spouse to another. Why you would want to do this is you would do this if it were to save you income taxes. Certainly you wouldn't split income to increase your taxes. So in an example where one spouse has $100,000 of income and another spouse has, say, $40,000 of income, if there's pension income, some of that can be transferred to the other spouse. Income from an RSP is not considered eligible pension income, but a RIF is considered eligible pension income. And the requirement to convert your RSP to a RIF, that must be done by the year you turn 71. So in those intervening 6 years, when you become 65 and you're eligible to pension split, it may be beneficial to convert your RIF. You convert your RSP to a RIF earlier to allow for pension splitting if there are large differences in income between spouses. A couple other benefits for pension splitting is that it will potentially help reduce installments for next year. As Jacob mentioned, if you have owe tax over $3,000 in the current year, you're required to pay installments for the following year. And so if one spouse has an installment requirement based on $5,000 and another they only owe $1,000, and after pension splitting they can both get under that $3,000 threshold, well, that helps eliminate the need to make installments for the following year. Next, I'll switch focus to a credit. And I have another question for the audience, and that is, which of the following conditions may qualify for the disability tax credit? And so, well, not a deduction, the disability tax credit is for individuals with a severe and prolonged mental or physical impairment. And so there have been cases where all of the above conditions may qualify for the disability tax credit. The important, or the, as I mentioned, the consideration for it is whether it's severe and prolonged, and so it's assessed on a case-by-case basis. But to apply for the disability tax credit, it requires your doctor or medical practitioner to prepare a form called a T2201. And with that, the doctor would answer a series of questions relating to the individual's impairment. And that form would get sent to CRA, and CRA would make a decision as to whether the individual would be eligible for the disability tax credit. The disability tax credit for 2023 results in a credit or tax savings of about $1,800, and so it is a beneficial credit. And I would say if you're not sure if you yourself or a dependent, a child, or a parent would qualify for the credit, reach out to us and we can provide some further information. With the credit, it is potentially retroactive to when the impairment began. So if the impairment began a number of years ago, but the application hasn't been made to CRA, if the doctor can answer the questions that yes, this impairment started a number of years ago, there may be an ability to amend prior year tax returns if CRA approves the disability tax credit. It can also be transferred from a dependent to a parent. So if there's a child, if an individual has a child with an impairment, the amount can be transferred from the child to the parents, or potentially if individuals are looking after an elderly parent, it may also be eligible to be transferred from the parent to the adult child. There are a couple additional supplementary credits that are available. The first, the Canada Caregiver amount, that's another credit that, to be eligible for that, there must be an individual must be eligible for the disability tax credit, and that looks at when an individual is taking care of someone with, or living with someone with the disability tax credit, as well as the child disability benefit, which is an additional amount that someone might receive if they're eligible for the Canada Child benefit amount. And lastly, the RDSP is a savings account that can be opened, and there's a lifetime contribution of $200,000 that can be helped to save for future expenses of the individual with the that is eligible for the disability tax credit. So the takeaway that I would have for the group here is that if you're not sure if you yourself or a dependent of yours is eligible for the disability tax credit, it would be worth at least applying to see what CRA's decision would be. The last topic that I will cover today is, and a question we do get quite frequently, is how long we've gone through all these number of credits, reporting how long do we actually need to keep all that stuff. And so the general rule is that it's 6 years from the end of the tax year that they relate to. So in this case, tax information related to 2017 at this stage would be the latest year that the records could be disposed of. However, there are certain exceptions from that general rule, and that's relates to if there have been acquisitions of property, so real estate in a year, or shares of companies, just so that those capital gains or losses can be calculated in the future. And you haven't sold them yet, it's still important to keep that information. Or if tax returns have been filed late, if your 2018 return is filed in 2023, well, there is an extended period of time where you need to keep those records. And a similar concept applies for if you're disputing any of your tax returns with CRA, there is an extended time period. And these are just some of the exceptions to the general rule. And lastly, I'll leave you with the records can be kept in electronic or paper format. The key is that they do need to be accessible by CRA if they were to ask. And it's important to keep backup copies of your information. If you keep everything in paper, maybe have multiple copies in different locations, or just in case of fire, flood, whichever the case may be, hopefully not. And similarly, if you have copies in an electronic format, consider having a backup in another location in case of any lost devices or corrupted files. So with that, I'll just wanted to say thank you to everyone for attending today. I think Jacob and I both covered a wide variety of different topics. And we hope they've been applicable to the participants here, whether or not that may be this year or in a future year. We hope we've shared some information with you to take away. And if there are any questions, we can answer those now. We do have another webinar scheduled for April 8th in a few weeks' time, where our colleague Jennifer Daw will be discussing registered investment accounts, so the RSP, TFSA, first-time home savers, and that'll be on April 8th at noon as well. And this recording will be on our YouTube page shortly after the presentation, and we do share updates on our LinkedIn as well. So if you'd like to stay informed, there's more information on those platforms. So thank you again, and we'll I see there's a few questions, so we can get to those.
All right, well, just mindful of everyone's time. I realize we're about half an hour in, but we do have a few more minutes that we can go through some of the questions that have been posed. The questions that have come in are excellent. And so the first one says, why doesn't CRA pay interest when they do not return the funds of the taxpayer that's owed to them? As a general rule, once your return is filed and you're owed a refund, let's say it takes CRA 6 months to process that return and get the refund paid to you. Well, during those 6 months, they will in fact pay you interest during the time that the file's been with them. And the rate they pay interest is 6%. So they'll charge you 10%, they'll pay you 6%. And oh, by the way, remember I mentioned that the interest that you have to pay is not tax deductible? Well, technically the interest that they pay you is taxable income, needs to be included in your tax return. So not all bad news, at least you'll get paid some interest. Now, the other caveat I have to that is that if you send CRA a bunch of money and it sits with them all year before you filed your return, and you get a refund when you file your return, they're not going to pay interest for the period that they've held your money. And so generally, I know people like getting tax refunds, but you're basically loaning money to the CRA for free, and only when you file your return does the interest meter start to tick. The next question says, are we able to claim an average number of days per year worked from home if under a hybrid model, or do we claim the same as if we worked every day from home? So I think this comes back to the reasonable basis of calculating what your employment expenses are for the home office. And I mentioned that, normally you take your square footage. Now, if you're using a dedicated home office space, you do it based on square footage. But then within that, if you're only working from home half the year, let's say, well, then in theory, there'd be a further proration of what amount of time you're actually working from home versus how often are you going to the office. So it is possible that you may have to do a further proration. A similar question came in. It says, can people claim home office expenses if they also spend 25% of their time at the company office? So definitely you can. The requirement here is that you have to have worked primarily from home for a period of at least 4 weeks during the year. So primarily generally would be 50% or more, meaning that if I'm working 3 days a week at home and I'm working 2 days a week at the office, I should satisfy this criteria. And as long as I get a T2200 from my employer, off I go, and I should be able to claim my home office expenses. Hopefully that those were the only questions on the Q&A board, so hopefully that addresses everyone's questions. If you had a more specific question, or maybe my comments didn't address the question you were trying to get to, feel free to reach out to either Nick or I, or to Henry Warren in general, and we'll be happy to help as we can. So with that, thank you everybody for your time today, and enjoy your afternoon.
Thank you.